All right, welcome to The Explainer. Today, we're diving into what's literally become a high-stakes battlefield, Indian crypto taxation. You might be holding Bitcoin, trading NFTs, or maybe just kind of testing the waters. But listen, if you aren't paying close attention to the rapidly evolving laws here, you are walking straight into a minefield. The taxman never sleeps, even if the crypto markets do. So today, we're unpacking the exact rules, the massive traps catching investors completely off guard, and how you can survive tax season without getting a nasty surprise in your mailbox. So, the big question on everyone's mind, will your crypto actually trigger an income tax notice? Well, there's this incredibly common and honestly super dangerous misconception out there. People think, hey, if I sell one token for a profit and lose money on another, they just cancel each other out, right? I owe nothing. No way. Actually, in the eyes of the Indian tax system, that line of thinking is an absolute fast track to an automated tax notice.
Level 1. The battlefield. What exactly is a VDA?
So the government doesn't just single out Bitcoin in the tax code. Instead, they've cast this massive, very deliberate net over what they call virtual digital assets, or VDAs for short. Now, this includes the whole shebang: crypto coins, exchange tokens, NFTs, and yep, even airdrop tokens. But check out what's strictly excluded here: the Indian rupee, foreign currency, and critically, the RBI's digital rupee, the e-rupee. That digital rupee is legal tender, whereas your private crypto, the government sees that as an entirely separate asset class.
Trap number 1, the immovable 30% rule. Bam, 30%. Income from transferring a VDA in India is taxed at a flat 30%, plus your applicable surcharge and cess. But here's the kicker, the thing that truly catches everyone off guard. The absolutely only thing you are allowed to deduct from your profits is your actual cost of acquisition. That's it. That means you can't deduct exchange trading fees, you can't write off your internet bill, you can't even deduct the interest on money you might have borrowed to make the investment in the first place. Brutal, right?
Let's put this into perspective with some concrete math. Imagine you buy a token for 2 lakh rupees, and later on you sell it for 3,50,000. Your taxable gain is exactly 1.5 lakh. Well, your tax burden is a flat 30% on that entire gain. That equals 45,000 rupees, plus cess. It's incredibly straightforward, and there is literally no escaping it by getting creative with expense claims.
Trap number 2, the big loss trap.
Now this is where we see the absolute biggest mistake investors make. It honestly feels like a plot twist in our survival guide. There is this massive myth floating around that netting a 1 lakh loss against a 1 lakh profit equals 0 tax. But the cold, hard reality, you are going to pay 30% on that full 1 lakh profit. And your loss, it gives you absolutely nothing. You heard that right. A loss on one VDA cannot be set off against your other crypto profits. It can't be set off against your salary, and you definitely cannot carry it forward to next year.
Trap number 3. Swaps and sneaky taxable events.
A lot of folks hold on to this super risky belief that tax only kicks in when you actually cash out your crypto to Indian rupees and it finally hits your bank account. Actually, scratch that. You need to radically expand your radar here. The tax follows the transfer event itself. Swapping one token for another token, that's a taxable event. Buying an NFT using your crypto, taxable. Paying someone for a service in crypto, yep, taxable. Even receiving an airdrop or staking rewards will often trigger a tax right at the moment you receive them. Basically, you can owe a ton in taxes even if a single rupee never touches your actual bank account.
Moving on to trap number 4, the 1% TDS illusion.
So, under the law, a 1% tax deducted at source, or TDS, applies on transfers of a VDA above a certain threshold. Usually that's 50,000 rupees for specified persons or 10,000 rupees for others. And look, it is so easy to see this 1% getting deducted by the exchange and think, awesome, my taxes are paid, we're good. But uncovering the truth here is absolutely crucial to your survival.
Here is the reality check. That 1% TDS is merely a tax credit, not your final tax payment. It's basically just the government making sure a digital paper trail is started on you. You are still legally required to compute your total income at the end of the year, disclose it properly, and pay the remaining balance of that massive 30% flat tax we talked about earlier. Don't let the 1% fool you.
The climax, the all-seeing eye.
If you're sitting there thinking, well, I'll just hide in the digital shadows, you are in for a serious rude awakening. Crypto platforms now sit squarely under strict anti-money laundering laws. Your exchange activity and bank trails, they're constantly being recorded, and that data feeds directly into your Personal Taxpayer Information Summary, or TIS. This then perfectly matches up on your Annual Information Statement and Form 26AS. The bottom line is, your transactions are already lighting up the government's tracking systems automatically like a Christmas tree.
The resolution, your compliance checklist. So how do we safely navigate out of this minefield? Make sure you equip yourself with these exact steps. First off, report all of your positive gains properly on Schedule VDA on your tax return. Second, remember the golden 30% rule. Never, ever claim unallowed expenses like internet or exchange fees. Third, meticulous record keeping is literally your best shield. Save all your wallet screenshots and transaction hashes. And finally, if you're realizing right now that you've kind of messed up your past filings, consult an expert. Specialists like CALO Kamar handle these exact mismatches daily, and you might still be able to file an ITRU updated return to fix the errors before things escalate.
We've covered a massive amount of ground in this explainer today, from the brutal 30% tax and the loss trap to those sneaky taxable swaps and the harsh reality of the 1% TDS. So, as you look at your own portfolio right now, I want you to ask yourself, is your past crypto filing a ticking time bomb, just waiting for a data-driven tax notice? Have you truly navigated all these traps, or is it time to get your records professionally reviewed before the system catches up? Take control of your data, get your filings right, and stay safe out there. Thanks so much for joining me today.